bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 5th, 2025 episode. My guest this week is Dirk Wallace. Dirk's a partner in Novogradac's Dover, Ohio office, and he's one of Novogradac's leading experts on the low-income housing tax credit, which I'm sure most all, if not all, of our listeners and viewers know, recently saw major enhancements in the One Big Beautiful Bill that was signed into law on July 4th by President Donald Trump. And now recently in the July 8th episode, my guest and Novogradac's Chief Public Policy Officer, Peter Lawrence, and I touched on some of those changes that were included in the One Big Beautiful Bill that affected the low-income housing tax credit. I invited Dirk back this week in order to help dive a bit deeper into 6 critical tax law changes that are in the bill or we might be pursuing in the future. Now, the 5 that are in the bill that we're going to talk about is, first of all, and this is obviously the top line change, and that's lowering the 50% finance buy test for private activity bonds to 25%. The second, which directly affects the ability to produce more financed housing units, is the 12% increase in 9% allocations of low-income housing tax credits. Now, both the lowering of the 50% test and the 12% increase are both indefinite parts of the tax code now. The third item that's of note for low-income tax credit financing is the return of 100% bonus depreciation, as well as a change to the calculation of interest expense deductibility under 163J. And it's really a bit of a back to the future change, which we'll talk about more. And then a minor note, but for some clients, it's a pretty significant change. It'll lead to a large loss of equity, and that's the sunset of Section 45 CAP-L credits. If you're not familiar with those, I'll have Dirk share his thoughts, give a brief explanation of what 45 CAP-L changes are. So those are the 5 critical tax law changes in the One Big Beautiful Bill: lowering the 50% test, 12% increase for 9% allocations, return of 100% bonus depreciation, a change to the 163J limits on interest deductibility, and then 5th, the sunsetting of 45 CAP-L credits. And then the 6th item I'm going to talk about is what wasn't included in legislation that the affordable housing community has been asking for with respect to long-standing tax credits. And we'll share a few ideas of what could be something that the community is looking for in future tax legislation. Before I dive in with Dirk on these topics, I do want to remind all of our listeners and viewers that we're holding a housing tax credit and bonds conference September 25th and 26th in Nashville, Tennessee. Invite all of you to join. It's going to be great to celebrate this large enhancement of the low-income tax credit, as well as talk about the implementation. States are already involved in implementing these various changes, and there's lots of active discussion about the tax credit equity market, and you can get up to the minute news then September 25th and 26th in Nashville, Tennessee. And yes, Dirk and I will both be there. And if you're listening to this podcast and you end up joining at the conference, please come up and say hello to Dirk and to me. I will include information how to register in the show notes. And you can simply also just go to our website at novoco.com/events, or just search Novogradac Tax Credit Conference, Nashville, Tennessee. And I suspect it'll come up. I've not checked it, but I suspect it will. So let's jump in with Dirk. We have a lot we want to discuss. So if you're ready, let's get started. Dirk, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's good to be back.
So this is your 15th appearance on Tax Credit Tuesday, which included your appearance as host for an episode last summer. Thank you for doing that. Now, for those that didn't listen to your last podcast with me, where you came and visited, there we talked about 4 possible tax law changes that would increase investor interest and boost credit pricing. Now, these aren't provisions that made its way into the one big beautiful bill, but there are provisions that would help increase investor interest. And over the last couple of months, my Washington Wire column and the Journal of Tax Credits is really focused on ways in which Congress and the president could increase investor interest in community development tax credits. And the reason why I'm emphasizing that is the more investor interest, the more desirability to invest in these various credits means you get more equity per dollar, which means the same amount of tax credits create more public good, be it more affordable housing, more community development, more clean energy, more historic preservation, and the like. But just in terms of the last episode that you were on, we discussed changing the carryback rules to a 5-year carryback of tax credits. And that affects, the various community development tax credits. Renewable energy already have a longer carryback period, but the idea is to create a 5-year carryback for community development tax credits. Also to allow community development tax credits to offset more than 75% of regular tax liability. Currently, there's a limit. Then we also discussed on the LIHTC tax credit, changing the passive activity rules to allow individual investors to join in more broadly. And also for community development folks, allowing the new market tax credit to offset the AMT. I do encourage our audience to go back and listen to that episode and learn more about some of those, as well as visit and review the Washington Wires that I've done, and then advocate as best you can on behalf of whichever of those changes you like. And if there are changes that you think should be enacted that aren't on my list, please email cpas@nofico.com. But let's not talk all about that for a different topic. But before we get to today's topic, I'm sure there's probably at least one listener or viewer who hasn't seen one of your previous experiences or previous appearances and haven't experienced it. Please describe to our audience some of the services you provide to Novogradac clients.
Sure. I work with a variety of industry participants, developers, syndicators, investors, perform various services such as audits, tax returns, financial forecasts, due diligence engagements. Yeah, basically, if you need anything LIHTC related, please reach out. I also head up our LIHTC working group, which as you can imagine, was very busy this year and especially the past couple months. So the working group works on regulatory and legislative issues, and we meet monthly. And so check that out as well.
Excellent. I would encourage those who aren't already members of the long-term housing tax credit working group to reach out to Dirk and do join. We meet monthly and we discuss current events, and it's a great way to stay current on breaking news, as well as to share your voice on comments on various regulations and the like, and deal with, interesting tax issues that are always arising that Dirk's able to address and help build consensus on. So Dirk, I appreciate you joining. I know you've given lots of presentations about these various changes. So this is about as much of a layup podcast. They're all layups for you, but this is really a layup. And let's start with the top line change, the change that's going to have the most impact in terms of the number of units that can be financed by long-term housing tax credits over the next 10 years. And that, of course, is changing the 50% test, lowering it down to 25%. And as our regular listeners know, we've said in the past that it actually used to be a 70% financed by test, which was lowered to 50% in 1989. And yes, I was practicing then. So I do remember it firsthand. And then it was 50% for the longest period of time until the July 4th tax law change, which brought it down to 25%. So tell me what developers should know about this change.
Sure. Well, for starters, as you point out, it is a financed by test. So in order to qualify for the 4% loan housing tax credit, at least 25% of your land and building costs or aggregate basis would need to be financed by taxes and bonds. This is obviously a decrease from the 50%. Looking at capital stacks, I know a lot of people like to talk about that and, what's the typical capital stack for a 4% transaction. And, I think prior to lowering the 50% test, a lot of capital stacks, especially during construction, had 50 to 55% of taxes and bonds, maybe 30% equity. Then you're looking at 15% for self-financing, or there's some variation of that. You got taxes and bonds, equity, and some self-financing. I think now that the 50% test is lowered to 25, I think we're going to see a large variation in the capital stacks of taxes and bond transactions. For property, maybe only needed 35% to fill their financing gap. That could be the 35% of taxes and bonds. And we could see recycled taxes and bonds come in. We could see taxable bonds supplement those taxable or taxes and bonds. Or maybe we see some construction financing, just regular market rate construction financing supplementing that. Of course, you'll have your equity, your soft financing as well. But I think this is the one time somebody say, fast forward a year from now, they say, what's your typical capital stack for a 4% transaction? The answer probably, well, there isn't a typical financing structure. It's, I think we are going to see just how projects are getting done. And they're going to get done based on their financing needs, which may be specific to a state or a county or whatever is available. And I think my advice to developers is, be flexible, and what might work in one state may not work in another. If one state's very fluent in recycled bonds, but another state may not be there yet. There may be a learning curve there for some of the issuers too. So yeah, I think
let me just interject here.
Yeah, sure.
Don't interrupt, but when you mention that, like the typical stack, it's always one of those things. Well, there might be an average and all the rest, but it could be a wide range. And I always think, when I think of this 50% test going to 25, I think of in the past, projects would get, say, 55%, something like that. The states want to give a cushion, but they also don't want to give too much of bonds because they want to go out and finance more transactions. So they want to kind of give you enough to get to the 50%, but not too much more. And then that 55% number, depending upon the types of projects, or some states and such, where those bonds ended up just being used to bring the 4% credits to the project, and they were paid down. And maybe they ultimately were only going to serve 30% of the capital stack, or even some where they get paid off completely because there's no debt on the property. So with the lowering of the 50% test to 25, basically, some projects that nothing's any different. They just don't touch bonds. They don't have to go through the bond burning, which is good. The bond issuance costs and all the rest. And there'll be those other states where there's some portion of gap that now the bonds will be less. So you have this gap. And as you pointed out, that gap, could be potentially financed with recycled taxes and bonds. So you still get the taxes and feature, but it's recycled bonds. So it doesn't bring 4% credits with it. It could be taxable debt. It could be that states themselves create additional soft financing to cover that. But it definitely, we definitely don't expect that the amount of soft financing that maybe is being out there now for bond deals is just going to double. So it's not as if that's all going to be taken up by other additional soft financing. But I do think many states will see this and they'll provide additional resources. So some of it will come there. I also just want to note that a lot of states have struggled, or developers in a lot of states have struggled to do preservation, acquisition, rehab transactions. And this is expected to increase the volume of acquisition rehab transactions moving forward. But I'll stop talking. Glad you continue. I couldn't help myself.
Oh, no problem. Thanks for that insight. I do think, in addition to looking at, obviously, the QAP in a certain state, developers should be looking at the guidance that states are releasing now on how a bond program may work in that state, especially the remainder of 2025 and into 2026. We're starting to see some states issue either proposed regs or a preliminary guidance. So make sure that if you are applying in 2025 or early 2026, that your application is within the parameters and the state's guidelines, and you're asking for specific amounts that line up with their guidelines.
Please describe or share with the audience the effective date, which is obviously influencing what states are doing now.
Good point. Yeah. So the effective date for the 25% test is for bonds issued and buildings placed in service after December 31st of 2025. So we're talking about bonds issued in 2026 and forward. And if you have a bond issuance currently in 2025 and you get a supplemental bond issuance in 2026, as long as 5% or more on an aggregate basis for remaining building cost is financed by a 2026 issuance, then you could also qualify for the 25% test.
And that's important because it means if a state is issuing bonds this year, or they're given the authority to issue bonds or allocating it out, they might be looking at this year and saying, either let's carry our bonds forward to next year and issue them next year instead of this year. So they only have to do the 25% test, or they might only allocate out, say, 20% of your needs and commit to giving you a bond issuance next year for another, 7.5% plus or minus, such that you're able to meet the 25% test next year, which is a way of basically taking 25 bond volume authority and maximizing and getting more units out of it, as opposed to using it all at the 50% test. I'd also like you to describe the rule on acquisition rehab transactions. Say I acquired a building this year and I'm going to do a renovation that gets placed in service next year. Does my acquisition basis be eligible and be financed subject to the 25% test?
No. And this is a great lesson.
Yes, I know the answer to that question.
So this is a great lesson learned from the 4% floor. A lot of you might remember back 4% floor was enacted. Some portions of the acquisition didn't qualify for the 4% floor, but the rehab could qualify for the 4% floor. For the 25% test, the rehab place in service date is going to govern place in service date for whether or not you qualify for the 25% test. So if you acquired a building in 2024, 2025, but your rehab is placed in service in 2026, your building will be considered placed in service in 2026 for purposes of the 25% test. So that was a good safe harbor rule that was put in place that we don't need regulations on it. So it was written right in.
I would also say, kudos to the industry-wide advocacy effort, including Novogradac's Peter Lawrence, to get language in on the effective date that answered these questions. So we didn't have to wait for IRS guidance. So it really is a good demonstration of effective advocacy, kind of in the weeds advocacy, not just lower the 50% test, but let's talk about the effective date and come up with something. So once it is enacted, we can hit the ground running, which we're able to do. And there's so much more I feel like we can talk about on lowering the 50% test down to 25% in terms of all the different ideas people have about ways to fill financing gaps and the like, but we only have so much time in the podcast. Anything else you wanted to share before we move on to the 12% increase?
I think that's all for now. If you want more, we did have a webinar a few weeks ago that covered a lot of this, so feel free to check that out on demand.
Great, thank you. And we'll include a link to the webinar in our show notes. So next, I wanted you to describe the impact of the 12% increase, the 9% luxury tax credit. And let me just note for the moment that the 9% credit did not become 12%. There's a Twitter chain going on where someone initially thought that we had said the 9% credit became 12%. It was no, there's a 12% increase to the 9% credit. So please describe for our developers what they should know about that.
Next. That's interesting. I had heard a few folks say that as well. They're like, we have a new 12% credit.
I wish.
So as many of you may recall, the ask, I think the original ask was, let's have a 12.5% increase. And then if you go all the way back to the Floor Housing Credit Improvement Act, it was, restoring the 12.5% increase, as well as a 25% increase in 25 and another 25% increase in 26. So with this one big beautiful bill, it started out at 12.5 in the House, but it made its way over to the Senate, and we, as an industry, got a 12% increase. So really what that does is pretty much what it sounds like. It increases the supply of credits, of 9% credits by 12%. And that's a subtle increase per capita amount that'll increase the small state minimum. And I believe every state is likely oversubscribed on their 9% allocation. So it certainly won't go to waste. And so starting in 2026, you'll see that increased supply of 9% allocation that you can apply for. And so hopefully that'll lead to more projects being financed in your state.
Great. Thank you for that. And I will say there are some thoughts that maybe one of the sources for the gap financing for bond deals, if the finance by test is lowered and there's ability to do more deals and you look for more soft financing, is to maybe use 9% tax credits, combine them with 4% on what are considered from a tax perspective, two separate transactions. And obviously we're not going to go into the combining 9s and 4s, but that's one of the ideas that's out there as states look to get and be innovative as ways to use these resources to generate more affordable housing units and to finance more affordable housing through preservation, act rehabs, and the like. The one other thing I wanted to mention, I'm sure there's a tax attorney out there. When we colloquially were referring to the fact that you have to finance 50% currently and starting next year, 25% of your landed building or your aggregate basis in order to be eligible for tax credits. That's technically not true. Technically, you would actually be entitled to credits on just the portion financed by the bonds if you fail the test. So instead of getting credits on the entire project, if this year, if you had bonds issued at this 50% threshold, you finance 40% of your project, then you get credits on 40% of the project. Well, getting credits on 40% of the project versus 60% of the project might as well be like not getting credits.
Yeah.
I'll just toss that out there that the person who's listening really technically and wanting a more technical answer. But let's turn to bonus depreciation. What should developers know about the return of 100% bonus depreciation, or said differently, why should they care?
Right. So 100% bonus depreciation will accelerate depreciation in the tax losses in a transaction. I think the key with bonus depreciation, especially in this first year in 2025, is going to be the effective date. So looking at the language, the effective date is for qualified property that's acquired, placed in service after January 19th of 2025. I've had a lot of people come to me and just say place in service after January 19th of 2025. And they're skipping over the acquired part because they think it just means you bought it or you purchased the property. And the definition of acquired is when you have a written binding contract to either purchase the goods or have the services incurred. So if you have a written binding contract on January 19th or before, that property would not be eligible for 100% bonus depreciation. Especially, if you acquired the actual property in say 2024, you incurred site work costs, but maybe they're not placed in service. And those site work costs were placed in service in April or May of 25. That would not be eligible for 100% bonus because you had a written binding contract prior to January 19th of 25. So you really need to look at when that written binding contract was for that property that you want to take bonus depreciation on. There may be some out there saying, well, I have qualified property, but I don't want 100% bonus depreciation. Can I take a lesser amount, or is it just 100% or zero? And in this first year, the first taxable year after January 19th of 2025, you do have the ability to elect 0%. You can take 100%, or you can go based on the rules prior to passage, and that's 40% bonus depreciation for 2025. So you do have the 0, 40, or 100% options in 2025. After that, it's going to be 100% or 0 for the bonus. So some key dates and some options there to think about as you're looking at capital accounts and looking at what's best for your property.
And in terms of why developers should care, I would just note that if you can expense 100% of personal property, and more notably land improvements, versus depreciating over 5 years or 15 years, that you increase the tax benefits, accelerate the tax benefits to investors. And if an investor is focused on tax loss and tax credit benefits, then that will drive their yield up, and they, all things being equal, are willing to pay a little bit more. That being said, I know lots of investors are less focused on that, and so it's not as if it's applicable to every investor, but it's absolutely additive and absolutely does matter for many investors. So let's turn to interest expense limitations, which we refer to in the tax rule as the 163J limitation. That was a limitation that came into being with the Tax Cut and Jobs Act back in 2017. And the broad concept was limit the ability of companies to deduct interest expense. It ended up being a bit of a pay for as well as was designed to disincentivize to a certain extent companies financing their activities with debt as opposed to equity. Obviously, debt financing plays a pretty critical role in the rental real estate rule, especially in the locally tax credit rule world. So please describe the rule as it exists before passage of the One Big Beautiful Bill, and then what the One Big Beautiful Bill did and the effective date.
So the 163J calculation looks at your earnings before income tax and originally allowed you to add back depreciation and amortization. However, that stays down. So for the last few years, you could not add back depreciation and amortization, which we know that is the very large expense item on your tax return and really limited your ability to deduct interest. So what would happen is most partnerships would elect out this limitation. By electing out, it would change your appreciation of your building 27.5 to 30 years, and you're not subject to this limitation. A lot of partnership agreements that now, that are now being written do have a section where you're basically required to make the 163J election. But I would say discuss with your investor to make sure that that's still the case given this change. There may be an instance where the 163J election would not be made and you could still deduct most of your interest because you can add back your depreciation and amortization. Again, this has an effective date in 2026 as well.
So I think of it somewhat simply, and I'll ask you to comment on my simple way of thinking about it is, if you think of a rental real estate property with NOI, if you have to determine your 30% limit based on NOI less depreciation, well, that's going to be a negative number for a number of years. It eventually gets to be positive, but for a number of years, it's going to be a negative number because of depreciation expense being more than your net operating income, such that if you do your 30% limit, you'd have zero interest deducted. The election out is basically saying, I'm just going to depreciate my property over 30 years instead of 27.5, and then this rule doesn't apply. So when you think of LIHTC developments in the early phase, virtually all of them would be making this election because, what are the chances that your interest expense is less than 30% of your NOI? So when you can add back depreciation, it just means your NOI is what you're essentially limiting your deduction to 30% of that. And obviously, if you have a 1.15 debt coverage ratio or something like that, your interest expense is a lot more than 30% of your NOI. That being said, there can be circumstances sort of later in a deal where your interest expense maybe is getting paid down, you've refinanced, you've done something differently, and your NOI has sort of grown such that maybe you don't want to make the election to do a slightly longer depreciable life. What do you think about that?
I think that's a good way to look at it. Yeah, definitely taking all that into account. And that's a good explanation.
And then I guess the other thing I would say is that if the property is, from a cost perspective, is high relative to the amount of interest expense, then you might find that 30 versus 27.5 more of a penalty than the interest expense limitation. But that's also a pretty rare occasion. But obviously the fact that it's rare doesn't mean you shouldn't be asking these questions and working with someone who knows to ask these questions. So you are optimizing. And then as you pointed out, at the end of the day, you always want to make sure whatever you're doing or the investor / syndicator is on board with what you're doing. And you always look at your partnership agreement.
And I will point out last time that there was a change to the calculation because the calculation changed a few years ago where it allowed a 50% limitation instead of 30%. The IRS did issue guidance for those transition rules where they did allow you to revoke what was previously an irrevocable election. So I would say look for guidance if you think you might want to change. The IRS typically would issue transition guidance in this instance.
Yeah, and thank you for that clarification. And I was obviously talking about it, the rule right after TCJA. So let's talk about the fifth item, which is the 45 cap L phase out. And this is the first three or the first four items we talked about are all positive. This isn't. So please explain what our audience needs to know about the 45 cap L phase out.
Yeah, I would say the 45 cap L credit we received the harshest treatment, I would say, as far as, not really having any safe harbors, not having any, if you start construction by, transition rules, there's a hard stop. If your unit is not placed in service and leased up, especially leased up by June 30th of 2026, then that unit will not qualify for the 45L credit. You'll notice that I said unit and not property because this is a unit by unit credit. So there could be an instance where if you had 50% or 60, 70% of your units leased up by June 30th of 2026, you can still take the 45L credits on those units, but the other units you would not be able to. So in this case, it's not an all or nothing type of credit building by building. It is unit by unit. So I guess there is sort of a silver lining, if you want to call it that. But yeah, there is a hard stop. That sunset was accelerated, I think, more than most energy credits. And I know a lot of properties that were underwritten, a year or two ago were contemplating an acceleration of the sunset by this much. So yeah, it could be anywhere from 500 a unit to 5,000 a unit, based on the energy standards that you meet, based on whether or not you're paying prevailing wage. So in some properties, it could be significant if you're receiving 5,000 a unit for that property. So definitely something to talk to your property manager about. It's just, try to accelerate lease up as much as you can in order to get these this one-time credit for the year.
Just to put a point on your $500 to 5,000 a unit, if you're a 200 unit building, it's $1 million in tax credits. So there's going to be an equity adjuster associated with that if you don't get it.
That's
So now let's turn to the legislation that was not included. What are some of the key legislative agenda items that were not included that you see the broader affordable housing community focusing on in the weeks and years ahead?
A lot of them dealt with basis boosts. We know for 9% allocations, there's a discretionary basis boost that the state can give. There's one of the things in the Affordable Housing Credit Improvement Act was a discretionary boost for the tax and bond transactions. That would be nice. 2 basis boosts, and they were actually in the House bill. We had the rural basis boost and the American basis boost. Those, again, were in the House bill. They didn't make it into the Senate bill or the final bill. So I think those are 2 basis boosts that hopefully will kind of be low hanging fruit maybe for the next bill. But yeah, I would say in addition to those boosts, there is extremely low income boosts. That's also in the LIHTC, simplifying the 10-year hold rule, really just enhancements to the program that, the basis boost will obviously increase the supply a little bit, but there are a lot of other enhancements that would just simplify, the program a bit that the broader community, I think, would like to see.
Great. Thank you for that, Dirk. And to our audience, if you have questions or want to know more about partnerships and loan facility tax credits and the like, or other tax credit transactions, please do reach out to Dirk. I will include Dirk's contact information in today's show notes. With that said, Dirk, please share some additional resources for our audience.
Great. As we mentioned, we do have a lot of webinars on demand that you can catch up on a lot of this. Especially if you have solar on your project, there's a renewable energy podcast series to definitely check that out. I know Tony Grappoli, one of our partners, is kind of leading that series. Yeah. So definitely a lot to digest if you have solar on your property. You want to know those transition rules as well. And of course, check out the Loan Housing Tax Credit Working Group, and I hope to see you in Nashville in September.
Great. Thank you, Dirk. And all those items, as I mentioned earlier, will be included in today's show notes. Please do stick around, Dirk, for the off-mic section. But before we get there, I do, as I do every week, want to encourage our audience to subscribe to Tax Credit Tuesday on whatever platform or platforms you get your podcasts. For me, it's Apple. And if you're watching on YouTube, please take a moment to like the video and share a hopefully positive comment on the video. By liking and sharing a positive comment, it raises our visibility. And please do share the podcast with colleagues. It's a great way for various colleagues to stay current and or newer hires to learn more about this industry. Obviously, with any industry, a lot of it is learning the vernacular. And listening to Tax Credit Tuesday is a great way to learn tax credit vernacular. And we do have a full archive of episodes available on our website at novoco.com. So now we are in our off mic section. And this is a space that we like to use to give a shout out to others working in the tax credit world. It's an opportunity to highlight a professional worthy of recognition. Dirk, who would you like to give a shout out to?
Well, given we've talked about lowering the 50% test to 25 so much, I would like to give a shout out to Ken Newman with Tiber Hudson. He was on the webinar with me that we talked about, where we went over a lot of these changes. And I know he's been on a lot of other webinars talking about lowering the 50% test to 25. So big shout out to Ken.
And I'll echo your shout out to Ken Newman. He and I were recently on a panel together at NCSHA's Credit Connect. That's the National Council of State Housing Agencies. And I always enjoy Kent's insights and also appreciate Tiber Hudson and Kent's work with us in developing our U.S. map of states that are either oversubscribed for private activity bonds for residential housing or roughly at parity or undersubscribed. Something we've worked on with them for years now, and I really appreciate that partnership. Thank you for being on the podcast today, Dirk. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.